Some very good news from the Labor Department. The U.S. economy adding 200,000 jobs in January, while wages rose at the fastest pace since the recession, 2.9%. The strong jobs report sparking a surge in bond yields as investors fear it's going to cause the Fed to raise interest rates next month. The rise in treasuries causing stocks to fall. The markets are now on track. Well, gosh, look at this, guys. We are down 505 points, now sitting at the lows of the session. That breaking, take a look at the Dow Jones Industrial Average, S&P and Dow, both on track right now to see their biggest losses in 1 week in 2 years. Joining me on set, Bullseye Brief author and publisher, along with Wall Street Journal chief economics correspondent John Hilsenrath. John, I mean, we haven't been raising rates at all, like in forever. So I understand that this is of some concern to some investors, but in a normal environment, you do have rate increases. And what I'm hopeful for here is we're getting back to normal. And there's an opportunity for growth, 5.4% predicted from the Atlanta Fed. Okay, so maybe the Fed raises, but can't we handle that?
Well, I mean, it's interesting because the market has been handling it. The Fed started raising rates in December of 2015. They haven't done it a lot, but they have been pushing up rates. I think there's a lot of things that are bothering the bond market right now. One is the idea that the Fed is going to be raising interest rates more aggressively. The other is that the bond market is sniffing out some signs of inflation. We saw it in the wage data. Inflation has been below the Fed's 2% target for years now, so it looks like we're getting something like more normal inflation. And we're also looking at bigger budget deficits for the U.S. Estimates as much as $1 trillion looking out at the next couple of years. And I think that's all worrying bond investors. That's pushing up long-term interest rates. You could call this normalization. Interest rates below 3% are not normal. And the Fed's benchmark interest rate below 2% is not normal. So you could call this normalization. The stock market had a very good run. It's also more normal to have a little volatility in the stock market. It can't go up every day.
Yeah.
And so we're seeing some of that volatility right now.
Yeah, and maybe some people are taking some profits here as they head into the weekend. But we are now, these losses are accelerated off 530 right now on the Dow. You say it's a buying opportunity. Why?
Yes, it is. And I'll tell you why, Trish. As you've been talking about, what happened today was extremely good. Wage growth. People are making more money. Thank goodness. More people are working. This is so positive, Trish. And what's ultimately going to happen is people are going to realize that 15% earnings growth as people make more money is way more powerful than the Fed raising rates by just 1 percentage point over the course of the year. It's an economic growth story, but what happens is you kind of have to adjust your thinking, and that's what we're all doing today. We're adjusting our thinking. We had the best January stock performance in 28 years. We're just giving a little back. That's
okay. So adjust thinking to what? Okay, we're in an interest rate rising
as John just said, we're getting back to normal. We became the nanny state. Think about it. The Fed came in, they did what they had to do. They had our back, and God bless them. They had our back. They stayed around too long. They kept rates lower than they needed to be. We now have companies issuing guidance every 8 weeks. Here's what we're doing. Here's how the earnings numbers are going to look. We've become a nanny state. I mean, think about it, Trish. For crying out loud, under President Obama, we worried about who can go to which bathroom and whether you can use a pronoun he or she. It's time.
They still worry about that at Google, by the way. I heard it's
But it's time we get back to normal. Come on, man up. Recognize that not everyone's always going to have your back. Markets don't go up every day.
The Fed can't be there.
We're getting back to normal, and this is something to embrace.
Yeah, John, I like that the Fed's getting out of the picture. I think that this is the right thing for our economy. It's the right thing for our country. And, maybe this also spurs some economic growth in that, you're thinking about buying that new house. Maybe you go out and get that mortgage today and you buy that house today as opposed to waiting a year or 2 years. If you're a company, maybe you go out and you make that capital expenditure or investment now, not just because of tax reform, but also because you have the threat of higher interest rates on the horizon. And that will cause people to move as opposed to waiting and waiting and waiting.
I think we could get that with long-term interest rates rising. That means mortgages are getting more expensive. I think we could see people trying to lock them in now while they can. You know, as far as the Fed goes, I think we have to realize there's two things going on with the Fed right now. One is they're raising short-term interest rates. It looks like they're going to do a little bit more than they had planned. But the other is they have a $4+ trillion securities portfolio of Treasury securities. They're winding that portfolio of securities down at a time when budget deficits are rising and the debt is getting bigger. That means more pressure on the bond market, and that's one of the reasons why long-term interest rates are going up right now. It's not just that there are these signs of inflation. It's the fact that the supply and demand equilibrium is shifting right before our eyes.
Well, I just want to remind people, too, I mean, there's always been this concern, and by the way, we heard it forever, that interest rates are just, boom, going to go sky high overnight. It doesn't happen quite overnight.
Nope, it doesn't.
And this may be the beginning of them moving higher, but it's not as though you're going to flip a switch and, you don't have the opportunity to adjust to those changes. This is one of the signals. And let's not forget, guys, this is good for savers like my mom and dad that can't get any yield on a CD because we have extremely low interest rates. I mean, there's some silver lining in all this, too. So I think, Adam, you're right to say, hey, take a deep breath on this one. Market's off 530 points. It might be an opportunity, but do know that this is the new normal, and we should welcome. We really should welcome a little inflation.
And again, Trish, yes, 15% earnings growth is a lot more powerful than the Fed raising rates by 1%, and that's the bottom line.
We can handle it. Adam, John, thank you so much. Good to see you guys.